Good day friends. In the subject of fundamental of investment, in this lecture I will be talking about efficient market hypothesis. Friends, there are three broad approaches of security valuation. One is called fundamental analysis, the other is called technical analysis, and third approach is called efficient market hypothesis. I will be talking about efficient market hypothesis today, but let me just tell you for a minute or so about fundamental analysis and technical analysis. In the fundamental analysis, we try to find out the intrinsic value of the share by analyzing the balance sheet, by analyzing the income statement, and there are various factors on the basis of which we analyze what is the fair value of a share, what is the fair value of a security, right? You analyze the balance sheet, you analyze the capital of the company, the reserves of the company, to what extent the profits of the companies are growing. This you analyze through the income statement of the company, how much cash flow is there in the company, what is the net cash flow that the company is generating, and there are various factors on the basis of which you try to find out the intrinsic value of a security. That is known as the fundamental analysis. Means we try to find out that what is the right price of a share. In the technical analysis, on the basis of past volume and on the basis of past data. Volume, when I say volume means the number of shares traded and what is the volume of the share traded in of that company, right? So on the basis of past price behavior and the volume of that company's share, means what is the amount in the sense, what is the quantum of the shares that is being dealt. On the basis of this price and volume data, we tries out that when is the right time to buy this share, right? When to buy it. So fundamental analysis and technical analysis is based on the previous data of the company. So fundamental analysis helps in calculating the intrinsic value of the stock based on financial information. Technical analysis helps in predicting the stock price movement based on past price and volume data. Whereas, now comes the efficient market, whereas an efficient stock market is one which the price of any given stock effectively represents the true intrinsic value of a stock. What it means is that it is the stock market. It is the market which tells you what is the right price or what is the wrong price. The individuals cannot judge. It is the market that judge. It is the price that you can see on the screen, right? At a particular point of time, the price at which the stock is trading, that is the right price. I'll be telling you what reason they give, right? So, as per the efficient market, every time the price that is being reflects in the stock market at a point of time, that is the right price. You cannot judge as a common investor, you cannot judge that what is the right value of the share and when is the right time to buy the share. This is, I am saying, quoting the efficient market hypothesis. Efficient market hypothesis is based on the premises of random walk theory, which I will be talking of, right? And it says at any point of time, I am repeating, at any point of time, whatever the price that is being reflected in the market, that is the right price. Investors, a common investor, cannot judge that what is the right time and what is the right price of buying a share. Every time is a right time to buy the share if we take the efficient market hypothesis as a theory. So this is a very efficient market theory is efficient market hypothesis is also based on random walk theory. This theory is based on the assumption that the stock prices follow a random pattern or walk. Means there is no set pattern, there is no set price behavior, there is no trend as such on the basis of which the share price behaves. It is on the basis of random walk, random pattern, right? The price is being reflected in the market. It implies that one cannot predict the successive price changes. What will be the price tomorrow? You cannot predict. What will be the price after 1 hour? You cannot predict, right? Because I'll be telling you the reason. So it implies that one cannot predict the successive price changes. If the stock prices are predictable, that shows market inefficiency and investors' irrationality. If you can predict the share prices as per this random walk theory, I'm not judging whether this is right or wrong. This is one of the theory that if the prices are predicted in advance, that shows that market are inefficient and investors are irrational. It represents a weak form of market. It means in a strong form of market, you cannot judge the future prices. And if the prices are to be predicted, are predictable, I would say it represents the weak form of market. So random walk model can be presented as follows. Price at t, pt refers to price at the point t, period t, is equal to p t minus 1, immediate preceding time, plus et. That p t minus 1 is equal to price in the period t minus 1, means previous period. And et is a random term which is unpredictable. That is, if you want to understand in a simple language, I would say it is any random factor that will affect the price of the share. Means any new information comes, any information which can affect the share price will lead to change in the price. At a particular point of time, you are seeing one price, right? What will be the future price? You cannot predict. It is on the basis of random walk. So any factor, any random factor which is unpredictable, which cannot be foreseen, right, will happen, and that will lead to change in the price. So price at the point of t is equal to pt minus 1, that is what was the price in the immediate preceding period, plus et, that is a random factor which can affect, which is unpredictable. So this is called the random walk theory. That is, the past behavior of a share price will not, on the basis of, by studying the past share price behavior, you cannot judge the future price. You cannot judge the current price, right? So past trend is no indicator of a future price. Any random factor will happen, and that will lead to the change in the share prices. So means the successive change in the price is not dependent on the previous price. It depends on the causal factors, it depends on the random factors, and as the random factor will change, so will be the change in the price. So the change in the price will lead to the change in the price plus the effect of the random factor. Now, what is this efficient market hypothesis? It implies that prices of the securities quickly adjust to all available and new information and reflect in the market price of the securities. Friends, what it says is that price of the share is based on the news flow. That any news flow that happens in the market will make an impact on the share price. If there is a positive news, let me give you an example. Supposing a company comes out with a result, with the quarterly results, right, and it gives a profit which is being perceived by the market as a increase in the profit. If the profit increases, it will have a positive impact on the share price. So immediately, as this news flow, the moment this news flow comes in the market, the company X has declared its quarterly results, and if these results are good, right, it will make a positive impact immediately on the share price, right? If the results are not good, right, so what is good, what is bad, it depends on the market expectations also. If, because markets expect in advance that the results will change, and that the investors have already discounted that flow, that there will be good results. But if the results are good, but if it is less than market expectation, the market price will fall. And vice versa, market expects that this time, because of the various reasons, because of the increase in the input cost, the results will not be so good, means the profit will not grow at the same rate which it increased in the previous quarter. But if supposing the profit increases more expectations, by more expectations of the market, more than the expectations of the market, it will have a positive impact on the prices. What I am saying is that at any point of time, as per the efficient market hypothesis, if it is an efficient form of market, whatever the price is that is reflected in the market, that is the true value, that is the true intrinsic value of the share. And as the news flow will follow, as the new information, anything happens which will affect which may affect the share price, any information follows, right? Then it is going to, market will adjust this information immediately. And how quickly it will adjust this as per the information depends on the efficiency of the market. There will be three forms of efficiency which I will be talking of: weak form of efficiency, semi-strong form of efficiency, and a strong form of efficiency. I will be discussing this. Therefore, the idea of market efficiency here is only concerned with the informational efficiency. Here we are not taking about the operational efficiency and other efficiencies of the market. We are saying that market will reflect, the share price will reflect the news flow in the market, and there will be change in the price on the basis of information inflow. A change in security price will only occur if something new happens. The prices are trading at a particular price. Supposing any news flow takes place, supposing information flows in the market that there is a war between the one country and the other country, right? Not with the country in which the share price is trading. I mean, supposing, if I take the Indian example, if there is a war between the two countries, say for example, recently the war is going on between the USSR and Ukraine, right? This led to the increase in the crude prices. This led to the increase in the commodity prices. And as soon as the news information of the war comes in the market, immediately it was being reflected in the market. It was being reflected in the share prices. Because if war takes place between the two countries, it means the geopolitical risk of the world increases. Supposing we come to know that there is a tension on the border of our country and the neighboring country, it means the risk profile will increase. And as the risk profile will increase, it will make a negative impact on the share prices of the companies, right? Because if the warlike situation takes place, it will make a negative impact on the share prices, because there are many negative impact on the profitability of the company, right? So what it means is a change in security prices will only occur if something new happens. New means as the news information flows, right, then the share price will change. In efficient market, there is no point in believing that current price is too low or too high. If the market is efficient, I said in the beginning of my lecture on this efficient market hypothesis that no price is the underpriced or overpriced. It is the market which gives you the right price, right? So there is no too low price or too, unlike in the fundamental analysis where it says that on the base of fundamental analysis we'll try to find out the right intrinsic value, we'll try to find out the fair value. It says market is efficient. It is the market which will determine what is the right price of the share, right? So no price is too low or too high. So there are three forms of market efficiencies classified by Pharma in 1970. Pharma is the one who gave this, right? So he talks about three forms of efficiency: weak form of market efficiency, or weak form of hypothesis we call it, semi-strong form of market efficiency, and a strong form of market efficiency. Means this efficient market hypothesis talks about, normally this efficient market hypothesis is known as EMH. This EMH theory talks about three different types of, three different forms of market efficiencies: weak form of efficiency, semi-strong form of market efficiency, and a strong form of market efficiency. So this classification is based on all available information. Now let me talk of weak form of hypothesis. Under weak form of market efficiency, the security's current price reflects all past data based on historical information. Means it is not a strong form of market efficiency, it is a weak form. In the weak form, the prices are discovered on the basis of historical facts. The past data that is already there in the public domain, that is being known to everybody, on the basis of these past historical information, the price is reflected in the market. Right? So, if it is a weak market, then on the basis of past information only, you can judge what will be the price that will be prevailing in the market, and it is the market at a point of time that will reflect in the share prices. Means it is a price that will be reflect in the share, right? So means share price will be reflected in a market on the basis of, if it is a weak hypothesis, on the basis of past historical information. This version implies that historical prices are not useful in predicting tomorrow's price. Means you cannot predict future prices on the basis of historical. Whatever the price that is being shown, that is the right price. So successive price changes in the form of market follows a random walk and are non-stationary. Right? So it is a non-stationary, and successive price changes in the follows a random walk theory, as I discussed in the random walk theory. It discards the technical analysis. Means on the basis of past price data, on the basis of trend analysis, you cannot judge what is the right price, what will be the future price. It discards the technical analysis. When is the right time? Like in the technical analysis, when is the right time? It will be revealed by the technical analysis, by judging the price behavior and by judging the volume behavior of a share. But it discards this theory. So what is the implication of this weak form of market efficiency for the investment? So investor can earn higher profits by using fundamental analysis and publicly available information through reports, financial statements, etc. Means you analyze this, you analyzed in a proper perspective, in a scientific manner, and on the basis of that, you can earn a higher return. So stock prices follow a random walk. Technical analysis of no use in the form of market. This I have already said. Now coming to the semi-strong form of market. This is the second form of market efficiency, means the previous one was the weak form of market efficiency, where the prices are being reflected on the basis of historical facts only. In the second form of market efficiency, the security prices reflects all publicly available information, means the current, including the current information, all financial and operational information. All financial and operational informations are being revealed in the share price. Since the stock prices are already adjusted for publicly available information, no investor can earn superior profits and outperform the market using this information. In the weak form of market efficiency, I said, by analyzing the income statement, by analyzing the past balance sheet, you can earn more profits, you can earn make the investment, right, and make extra profit. But here if the market is semi-strong form, right, no investor can earn extra profit. Since the stock prices are already adjusted for publicly available information, no investor can earn superior profits and outperform the market using this information. What does it mean? That you can earn extra profit, you can earn extra return if you have some information which is not available in the public domain. You expect how the company's profit will behave, what will happen. Depending on the macro factor, you expect that what will happen in the future, and on the basis of that you predict a share price and you make your investment. Providedly, the market is semi-strong, not strong, semi-strong. So since the stock prices are already assessed for the publicly available information, no investor can earn superior profits and on the basis of the current information, using the current information. So whereas the new information is generated, all the participants assess the information with equal speed and efficiency. Whenever a new information is being generated, right, supposing as I was saying that the company announced the profits, company announced its quarterly results, right. As soon as the company announced its quarterly results, people will analyze that that result, means people means investors, when analyze the results in their own manner. So on the basis of equal speed and efficiency, everybody will judge the balance sheet, everybody will judge the income statement with the same speed and same efficiency if the market is semi-strong. But friends, let me tell you, the market practically is neither semi-strong nor very strong, right? Practically in the practical life, what we come across. So what is the implication of semi-strong form? Both fundamental analysis and technical analysis become useless in case of semi-strong form of market efficiency. Only those investors can earn superior profits who have access to private or confidential information, right? So in the weak form of efficiency, I said on a base of analyzing the income statements and the balance sheet, you can make the extra profit, superior profits. Here we are saying only those information we have who have access to the private or confidential information, only those people can earn supernormal profit or superior profits, providedly it is a semi-strong form of market. Now coming to the strong form of market. This is the highest form of market efficiency, where the security prices reflect all the prices and information, both public as well as private. If we presume that market is efficient of its strong form, it means at any point of time the share price will reflect all the available information that are there in the public domain as well as in the private domain. Means what is the expected profits of the company, what is the expected growth of the company. This market has, when I use the word market, means the investor class has already discounted it. It's a private, what will be the future growth, means all the different investors are predicting in the same direction that if it is a strong form, that what will be the growth of the company, what will be the growth of the profit, what will be the future, what will happen, what will be the macro factors, right? All these macro factors, the micro factors, the company specific information, right, are being analyzed by the investor in a similar manner, providedly if the market is strong, right, means the market efficiency is strong. So no investor can consistently earn superior profits as stock price is already adjusted for the information available. So whatever the information that is available, whether in the public domain or in the private domain means not specifically coming in the public, right, through the various informations, through available information, that is reflected in the price. Market is already reflecting that in the share price. That's why we say that stock market always means discount the future informations, right? It always discounts the future information, and on the basis of future information, it gives a particular price to a company. So security prices can only change by inflow of new information. So if any new information takes place, if any new information comes, then only the share price will be reflected. Say for example, Government of India or the RBI in the case of India announces monetary policy, right? Nobody knows in advance that what the RBI governor will do, right? Whether the CRR will increase, whether CRR will decrease, right? So cash reserve ratio will increase. What will be nobody knows. People only judge it, right? And supposing when the inflation is taking place, the governor of the RBI increases the cash reserve ratio. If the cash reserve ratio is increased, it means the rate of interest charged by the banks from the companies will increase, right? And this information will have a negative impact on the stock prices. So a new inflow of information market was not expecting. Say for example, market is expecting that if at all there will be increase in the cash reserve ratio, it will to the extent of 0.25%. But suddenly, because the RBI feels that the controlling of inflation is its prime agenda, and it increases the say for example the CRR ratio by 1%. So it's a shocking news for the stock market, means by the investor class, because nobody knew it, that nobody could predict it, that the CRR will increase by 1%, right? Everybody was expecting, if at all because of the inflation, right, the CRR will increase, it will increase to the extent of 0.25%. and if the news flow is that the monetary policy is being announced by the RBI governor and it says the CRR will increase by 1%. So this is a new information. This is the inflow of new information. This will immediately be reflected in the stock prices. So friends, so means that strong form of efficiency is that strong form of efficient market is where the stock market shows, the price shows all the available information, whether in the private domain or in the public domain. And the market efficiency, in the strong form of market efficiency, as the news flows changes, news flows comes, as the new information comes, as the new news flow takes place, immediately within no time the market, the share price is being reflected by this new information, right? And how quickly and how efficiently the information is being reflected in the share price, that is a sign of strong form of efficiency. If it is share price reveals, share price takes into account the information that is flowing on a very urgent basis, on a quick basis, we say it's a strong form of. If the new information takes place, the news flows takes place, but it takes some time in analyzing that information, it is not a sign of strong form of market efficiency, it is a semi-strong form of market. Because how fast and how quickly the news flows or new informations or informations are being reflected in the share price, that is a sign of the strongness, or there is a sign of the level of efficiency in the market. So the level of efficiency in the market depends on that all the available informations in the public or the private are being revealed in the share price, plus the speed with which the news flows are being reflected in the share price. That means faster is the speed, faster is the market efficiency. So friends, these are the three forms of market efficiency, that is weak form of market efficiency, semi-strong form of market efficiency, and strong form of market efficiency. Thank you very much.